In 2005, two identical houses sit next to each other on the exact same street. The buyers put down the exact same down payment, signed identical 30-year loans, and walked through their front doors on the same Tuesday. The starting line was perfectly even. One of those buyers unpacked their boxes and called their bank. They scheduled an automatic transfer of an extra $150 every month to go straight toward the mortgage principal. They didn't run a complex spreadsheet or brag about it at dinner. They just set it up and let it run. Next door, the other buyer looked at their layout and felt a gap between what the house was and what it should be. Within 60 days, they took out a $24,000 home equity line of credit to gut the kitchen, put in new floors, and build a massive island. Standing in the middle of a renovation like that feels incredible, but that feeling comes with a quiet mathematical reality. 2 months into homeownership, they attached an extra $24,000 of debt to a house they barely owned. Jump ahead 21 years. The person who set up that $150 transfer owns their home free and clear. The person who renovated the kitchen still owes $252,000, locked into monthly payments until the year 2050. The widest financial divides in our lives rarely stem from obvious disasters. They grow out of entirely ordinary, rational choices made on a random Tuesday, compounding in silence while we pay attention to other things. By 2010, the homeowner with the renovated kitchen gets a promotion. A realtor calls, mentions the market is recovering, and points out a bigger house 2 zip codes over. They say yes. Here is what disappears at the closing table: anywhere from 8 to 10% of your property's value. Agent commissions, closing costs, title insurance, and transfer taxes evaporate instantly. This is the friction tax of real estate. This chart shows how a standard 30-year loan actually operates. In the early years, the bank takes its cut first. A massive portion goes straight to interest, crushing the tiny principal sliver. After 60 months, you've accumulated about $15,000 in equity. When you pay the friction tax to move, that equity disintegrates to cover fees. Meanwhile, the neighbor who stayed put is quietly pulling their loan payoff date forward. Because they aren't moving, their extra $150 goes entirely toward the principal, shrinking the balance on which interest compounds without triggering a single transaction fee. Treating a primary residence like a liquid asset carries a steep penalty. Moving stripped the equity away and reset the financial clock all the way back to zero. 10 years later, the fall of 2020 brings global economic panic. Economies lock down, and the stock market goes into a steep, chaotic plunge. To keep the housing market moving, central banks slash interest rates to historic lows. Suddenly, the entire financial sector is aggressively marketing 30-year fixed mortgages at 2.9%. The homeowner sees an opportunity to upgrade again. They pull cash out of their equity, pay off the old kitchen loan, and lock in that 2.9% rate. On paper, their immediate monthly payment actually goes down. Look at what this timeline reveals about refinancing. 10 years into a mortgage, you finally reach the point where you're paying more principal than interest. But signing the new paperwork snaps you back to year 1, diving right back into that zone of pure interest. You are now 44 years old. You've just taken out a brand new 30-year loan. If you make every payment on schedule, you will be sending interest checks to a bank until you are 74. The industry calls this leveraging your equity. In practice, it is the banking system's most efficient mechanism for keeping you paying debt for your entire working life. That brings us to 2026. From the outside, both neighbors look identical. They are 50 years old with similar incomes, but their underlying mathematical realities are completely fractured. The homeowner who stayed in the original house has virtually eliminated their mortgage. That $1,100 monthly payment now redirects straight into an index fund, building raw wealth. The homeowner who upgraded twice is carrying over $250,000 in debt on the house they bought in 2020. That debt will outlive their career. The debt load is heavy, but the most devastating invisible cost is the $45,000 they burned in transaction fees during those 2 real estate loaves. This graph plots what happens when you leave money alone. If those transaction fees had been placed in an S&P 500 index fund starting in 2005, that money would have skyrocketed to nearly $400,000 today. Burning those transaction fees destroyed the critical seed money required to buy their own financial independence. In 2005, the person who bought the first house planted a $14 sapling in their front yard. It was a thin, fragile stick. That tree didn't reach above the roofline because of constant strategic interventions. It grew massive for one simple reason. It was left completely alone for 2 decades. The physics of wealth creation work exactly the same way. Compound interest is a machine that requires deep roots and uninterrupted, unremarkable stretches of time to actually do its job. A loan for a nicer kitchen, moving for a better school district, refinancing for a lower rate. Every single one of those decisions was reasonable, but normal is not the same as free. True financial leverage isn't found in a new zip code or a lower interest rate. It comes from making a quiet decision and possessing the discipline to let the math run its course without interference.